Well, big issue in the world today are the interest rates.
Nice segue.
And so,
What a great segue.
I don't feel like you mean that.
No,
I just felt we were at a hard stop, and
Yeah.
I'd just go on in there.
It went right into it.
Let's
yeah.
see, a segue.
Man.
You know what won't cause anal probes? Interest rates.
Interest rates.
How's
tell you
that?
what,
Is that a little better?
My interest is peaked. Anything that does not cause anal probes, I'm in. Let's go. Man, have you ever heard of coffee enemas? All right, Bo, what are you teaching me today?
Well, let's talk about interest rates.
All right.
But before we do, this is the day that the Marine Corps takes over Facebook. You know this?
I saw a post, but I didn't know what it meant.
Well, today, as we record this, it's November 10th, and that's the Marine Corps birthday.
Mm.
So on Facebook, what you have is generations of Marines all wishing each other happy birthday. And if you're plugged into that at all, like it just fills up your feed.
Oh.
And it's kind of jokingly,
Gotcha.
the day the Marine Corps takes over. But it's
Gotcha.
always November 10th. That's the Marine Corps birthday. But the Veterans Day is always right after that.
Mm-hmm.
And it occurred to me today why Marine Corps birthday is always right before Veterans Day. It's because we're always first.
Yeah.
I mean, it's very clear. And then Jay, our brother, sends me this little story. Hold on, I'll just read it.
Okay. Now that you bring up texts with Jay, something happened this week that I think is really funny too.
Okay, so you ready for this?
Yeah.
All right. Shh. Gather around, kids. Gather around. You're about to hear the story of Marine Corps Birthday Eve. 248 years ago, November 9th, 1775, Sam Nichols and John Adams walked into a bar and saw the dudes in there licking the pewter mugs, breaking iron ingots, smashing pottery on their foreheads, and lifting the largest women in town. They sat down with a bottle of George Washington's whiskey while discussing the jobless dudes over there in the corner. Around midnight, they decided the best way to control them would be to toss them in the bowels of a ship and only let them out to break things or people. Unfortunately, there was no budget to pay these lads, so they decided they would convince them that they were the best and give them the best-looking uniforms. The best.
The best.
John and Sam figured correctly that this pride would keep these knuckle-draggers content with little or no budget.
Knuckle-draggers.
Around sunrise on November 10th, they decided to call them Marines. They served honorably, but eventually needed a mom. So in 1834, they became part of the Navy because of the well-established, nurturing, feminine qualities that naval officers possess. Happy birthday, Marines. To all my Navy friends, just enjoy the laugh, and I'm sure you can come up with something to talk about how stupid and knuckle-dragging that we are.
Yeah.
A bunch of mouth breathers, but...
So I guess last week's episode was National Guard. This week, it's the Navy.
That's right.
Look out, Army, next episode. So I text him, you know those like lines in the sky?
Contrails.
Contrails. Yes, contrails. So the other day we're playing Tisbe, and I look up and like the sun's coming up, so they're like, I see like 5 of them in the sky. And I was like, what are these things? And I asked Leland and Dexter, and they didn't know. And so I just text Jay a picture. I was like, what are these? And then he just sends me the Google, whatever the definition you first find on Google.
Yeah.
I was like, okay, yeah, whatever. So then I just started having fun with Jay. I was just in a silly mood. He ended up asking if I had smoked. I was like, not yet.
Is this what he sent? Contrails are clouds that form when water vapor condenses and freezes around small particles, aerosols, and aircraft exhaust. Is that what he sent?
Contrails from jets. They are visible trails of streaks of condensed water vapor or ice crystals, sometimes forming in the wake of an aircraft.
Okay.
Right? Very close.
Yeah, basically. Okay.
And so I asked, why are there so many jets all the time? There were 7 of these I saw this morning. He goes, bro, Kentucky is near the middle of the country, so we fly over a lot. And so I sent this GIF of a cat being sucked up by a UFO, right? And then he sends me he goes, check out the flight patterns, right? Sends me this picture of the flight patterns. He goes, these are all the planes in the air right now around the borough. I go, that's what they want you to think. He goes, ha ha. What has you all paranoid? LOL. I go, the streaks in the sky. So many that are lit up so beautifully after morning Tisbe. One going straight up, one going down, one going side to side, one doing a wiggle, wiggle, wiggle. Another one making letters that spell TIMMY, MUSTBEPROBED. Timmy must be probed. He goes, I never been probed yet. Makes me antsy. Maybe it's nice. Is it nice? They probe in the military camp, right? He goes, fortunately, no. I've never been probed. Now, Jay's is a little slow when it comes to humor, everyone. He's very, very funny, but takes things very literally. He goes, fortunately, no, I've never been probed. Only stuck with too many needles. I go, now I'm nervous about the needles. Can you talk to the aliens from your cockpit? He goes, you getting antsy about aliens? You've been listening to Joe Rogan, haven't you? Ha ha. I go, I haven't listened to him in a long time. Just the message in the sky. I have kids now. I don't want to be probed. He goes, don't worry. There's no proof of aliens. I go, except for those streaks of condensed water vapor. He goes, well, I guess I'm an alien because I caused those. I go, I knew it. Please no probes. Please no. Not till I'm 50.
It's actually now 45.
Oh, is it 45?
And I'm about to have my first colonoscopy.
Yeah, baby. Yeah. It clears you out.
I was supposed to have one. I was supposed to have it last week, but they had to reschedule. I was like, no problem. No problem.
Oh, this is going to be fun. Then he said, I'm almost done here. He said, I didn't think you had a propensity for conspiracies. I go, not yet. I'm in a silly mood. Oh, he goes, did you smoke a little? I go, not yet. In a silly mood. Anyway, and then he sent me this GIF, right? Like some jets making a heart in the sky. Mm-hmm. And I said, all I can see is a butt about to be probed. And he goes, that's why I picked it. We get bumpy when we fly through them. It's called wake turbulence. Then I didn't message him back.
Okay. Too many 3-syllable words.
Yeah. Anyway, I just thought, I don't think I've shared that with anybody yet.
Well, now you shared it with everybody.
Everybody knows. Oh, man. Mm.
Well, big issue in the world today are the interest rates.
Nice segue.
And so,
what a great segue.
I don't feel like you mean that.
No,
I just felt we were at a hard stop, and I'd just go on in there.
It went right into it.
Let's see, a segue.
Man.
You know what won't cause anal probes? Interest rates.
Interest rates.
How's that? Is that a little better?
My interest is peaked. Anything that does not cause anal probes, I'm in. Let's go. Man, have you ever heard of coffee enemas? A coffee enema?
No.
No. Okay. Anyway, apparently it's really good for you and clearing you out. And I've got a friend that does it, to my surprise.
Performs them or enjoys them?
Both. They perform it. He performs it on himself, and it clears out his system. He feels great afterwards.
Okay, I got to be real honest, and I don't know why. But I'm just going to confess here. When you said I've got a friend who does coffee enemas, female is what I was thinking the whole time. And then you said he,
He, yeah. That's right.
And he does them to himself. Like you don't need somebody else to help you with it?
Apparently not. Maybe his wife does. But I haven't. Anyway, had to get that out of my head before we went into interest rates. Yeah, right?
I'm so disturbed right now.
Yeah.
Coffee is for drinking, man.
Mm-hmm. Yeah. And the whole, you butt chug some coffee.
Let's move on from this.
Okay. Interest rates. Something that won't cause
coffee
anal
enemas.
probing. Yeah, coffee. Because interest rates it's huge right now.
And, well, not only that, but it pretty much affects everybody.
Mm-hmm.
Well, it does. Whether you have a mortgage or any kind of debt whatsoever, even if you're renting apartments.
I just took a sip of coffee. Sorry, go ahead.
There's some kind of effect that interest rates play in your life. But, let's just say you're a homeowner. You just bought a house. You just got a mortgage. The way residential mortgages generally work is you most of the time get a 15 or a 30-year fully amortizing mortgage.
15 over 30, 30-year fixed.
15 or 30. So you guys, most people, I think, generally get a 30-year mortgage.
Whoa, you'll be paying that off until you're 70. You remember The Office where he's buying his condo?
I remember that episode,
Yeah,
but I don't remember that line.
Yeah. He's like 15 over 30, 30-year fixed. And then Dwight goes, wow, you'll be paying this off until your mid-70s. Basically buying a coffin. Go ahead.
But it's fully amortizing, which means you make the same payment and the term is 30 years and the mortgage amortizes over 30 years. So once you've made 30 years worth of payments or 360 payments, the loan is paid off. Okay. So that's how residential works.
I could tell you how commercial works.
Well, why don't you?
Yeah. So you've got 30 years amortization, right? So taking from this example. But in 5 years, you've got a balloon payment, which means after 5 years of paying that sum that's been divided by 30,
or
you have to
really
pay
360.
360.
Yeah.
You've got to pay it all off at once or refinance at the interest rate of that time.
Okay, so let me just tweak a couple things you said,
Sure.
because what you described is exactly correct, except you don't normally see 30-year commercial loans.
Okay, yeah.
Most of the time it's 20 or it can be 15 or 10. You don't stretch it out that long. And so you amortize, say, over 20 years, but as you described, the term of the loan is, these days, they're pretty much all 5 years, 5-year term. So you make that monthly payment, most of the time it's monthly payment, every month for 5 years. And then after 5 years, whatever the balance is left, that balloon payment is due. So you got to pay that off. Most of the time by refinancing, adding a new loan to the deal, and replacing the old one.
Or if that's not the case, the ideal situation is you've got it to a place where you're going to sell it, and then are you able to pay that balloon payment? Oh, yeah, that is a question I don't think we've ever covered. It's like when that balloon payment is due and you are set to sell it, we might come back to this. But
Well, let's just play that out.
okay, yeah.
Let's say I've got a 5-year term on a 20-year amortizing loan. Okay. And I'm in year 4. So I've got, in 1 year, I'm going to have to refinance this or pay it off. And let's say I sell it in the 52nd month. So there's 8 months left before that balloon payment's due. If I sell it in the 52nd month, then I just pay it off then.
Right.
And so at the closing, the mortgage gets paid off, the, brokerage fees, whatever other fees are associated with the closing, deed transfer tax, all that stuff. And then whatever's left is your sales proceeds, and you leave with that amount of money.
Right.
But the loan has been paid off.
If it doesn't sell by that date, right? But someone's there, you've got a buyer.
Then you
have to refinance. You can't be like, hey, give me one more month.
You can certainly ask for an extension.
Yeah. Okay.
That's where you communicate with your lender. Say, look, this scenario, this closing looks good. It's been pushed back 2 months. It's going to take me over. And they might extend it.
Gotcha.
Or you might you might be out of luck. You might have some other issues if they decide not to extend. Maybe you do have to refinance for a month, which I would imagine most of the time they would extend, especially if you're working with like local banks.
Sure. Yeah.
Which is my complete experience working with local and regional banks. So
commercial real estate's local.
The big lenders, I don't really know how hard and fast they'd be with the rules versus extending.
Right.
But it seems like it'd be in everybody's best interest to just go ahead and extend for a month or two and pay the thing off. And I see what you did there.
Yeah. Pun intended. Yep.
That's just sort of how commercial mortgages work, how they're a little bit different than residential mortgages. But you have interest rates are a part of that. Today, the 30-year fixed is around 8.3%.
And this is the average nationally?
Yep.
Yeah.
It's pretty high. I think in 2021 or 2022, Autumn and I refinanced our mortgage, and we got a 2.35%.
Wow. I don't remember ours in Chicago, but I think it was around like 4.
Yeah. So they've been low for a while.
Yeah.
Right. And this is the price you pay to borrow the money. It's your cost of funds.
Yeah.
What does it cost me to borrow what I need to buy a house? But in the course of 2 years, 2.3 to 8.3, it's almost 4 times more expensive to borrow money than it was.
Yeah.
Like, that's a big shift in a short amount of time. Okay. So what that's done on the residential side is people can't borrow as much. They can't afford to borrow as much. What they can afford is less of a house than what they could just 2 years ago.
Right.
Which has cooled the demand for home purchases. Not only that, but if you did buy a house in the last couple of years and your interest rate is a 3 or a 4 or a 2 handle on these things, like, you want to give that up? You want to sell, buy a new house,
right?
And now you're coming in at 8.3 or something like that,
right? So people
like,
aren't selling.
that's hard to do. So on the residential side, lots of people are just not selling. There's not the inventory that there was before. The demand is different because people can't buy as much house as they could just a few years ago. So people are feeling like they missed out and they missed their opportunity, and so a lot of people are staying where they are. Okay, that's kind of a very high generalization of the residential side.
Sure.
On the commercial side, though, you've got the same scenario. 2 deals ago, when we did that first strip center syndication, the interest rate was...
The one that you pitched me on?
No, the one before that. Interest rate was 3.49.
Yeah.
On a commercial deal.
Right.
And the next deal, the one I pitched to you...
Which you can watch right here.
That interest rate was a 4.19. And I remember being, I can't still get a 3.
Right.
We just had 2 interest rate hikes from the Fed, and we'll talk about kind of how that works here in a second. But and so all of a sudden I was at a 4.19, and I was really like, a 4?
Yeah.
Like, come on. I do think I got a 7-year term on that one.
Yeah.
But these are 20-year amortizations, and I think that 3 handle I got was a 10-year term.
Wow. That's so
I get
good.
that for a while, which is really nice.
Right in time.
The deal we're going to do and close on next month, 7.25.
That's not as bad as I thought, but still.
Well, it's a little bit better than residential rates, but
still, yeah.
It's a 7.25 when the deal you did 15 months before was a 4.19.
Yeah,
the one you did 10 months before that was a 3.4. I mean, it's like, so what that means.
It's a lot more money too.
The cost of borrowing for me has doubled.
Yeah.
Than what it was a couple years ago. So that makes me handle things a little differently. For instance, instead of, I think those 2 deals, those 2 strip center deals we did, I borrowed in about 65%. And then I went and raised from equity investors 35%. Well, in this deal that we're doing now, it's about 50-50.
Yeah, gotcha.
So I'm borrowing half. I'm borrowing less because it's riskier and it's more expensive. And so I'm bringing in more equity and I'm borrowing less. That gives me more of a margin of error, and that's a way I'm trying to mitigate the risk of higher interest rates and kind of some macroeconomic volatility.
Right.
So it got me thinking, on the commercial side, what I understand about what drives interest rates is it has a lot to do with the Federal Reserve, and it has a whole lot to do with the 10-year Treasury yields. But I didn't really know what 10-year Treasury yields were in the first place. I knew it was a thing, and when the Treasury yields go up, commercial interest rates go up, and when they go down, commercial interest rates go down.
Yeah, okay.
So I thought, I'll just do a little Google search and see if we can't get a little bit of an explanation on this 10-year. And to be honest with you, I think I just confused myself a little more.
Let's figure it out.
Well, I mean,
Let's figure
we
it
can
out.
do it again, but
Wait, confused yourself as far as like what the 10-year treasury yields are? Or
well, let's just Google why. You should not stop in the Google search bar with just why.
what popped up?
Why is Ethereum going up? So crypto.
Yeah.
Okay. Why is my poop green? Why is the sky blue? Why do cats purr? Why am I so tired?
So number 2 is why was my poop green?
And that's the one I saw.
Because of the rainbow ice cream that you ate yesterday.
Why is the commercial
My daughter knows that.
interest?
Can you explain at least what the 10-year treasury yields are?
Well, here's what the 10-year treasury is. It's a bond. It's a debt instrument where the U.S. government gives a bond that people pay for, and it's a debt instrument. So it's borrowing from people who buy the bond. And in return, they pay a yield, an interest rate to the person who bought the bond.
Yeah, okay.
All right. So it's a bond. It's a way for the government to raise money through debt.
What's the 10-year?
10-year is how long it takes for the bond to mature. And so let's say you put $10,000 in a treasury bond.
Mm-hmm.
And 10 years later, you're going to get that 10 grand back. All right. That 10-year part is I'm going to give the government $10,000 to use for 10 years. And during that time, they're going to make interest payments to me. And then they're going to give me that $10,000 back at the end.
Gotcha.
Right. So once the government issues all these bonds, and they do 1-month bonds, 2-year bonds, all the way out to 30-year bonds.
Mm-hmm.
So there's a spectrum of it. For whatever reason, the 10-year bond is the one that commercial real estate people pay attention to. That's the one that seems to
coincide
or indicate what interest rates are doing.
Yeah, okay.
This is what Google's initial answer is. My question is, why is the commercial interest rate tied to the 10-year treasury yield? The 10-year yield is used as a proxy or a substitute for mortgage rates and is also seen as a sign of investor sentiment about the economy. A rising yield indicates falling demand for treasury bonds, which means investors prefer higher risk, high reward investments, while falling yields suggest the opposite. Okay.
Mm-hmm.
Here's how this works. The government issues the bonds. Say you and I, say I buy it.
Okay.
And so I've got a 3% 10-year treasury. And you look at the future and you think, man, I think that's undervalued. You might want to buy that for me. So there's like a secondary market, much like stocks are traded.
Sure.
Bonds are kind of traded in that secondary market.
Yeah,
and that's where this yield play comes in. And so if there's rising yield, indicates falling demand for bonds.
Mm-hmm.
Or in other words, if there's falling demand, the market has to promise more money back to get people interested in buying them.
Mm-hmm. Okay.
And the reverse is true. Okay. So
more money back would mean a higher interest payment I'd be receiving.
Yeah. Or a higher payment. On the secondary market, it's more like it gets pretty complicated pretty quick, but essentially, yes.
Yeah. Okay.
So as that yield goes up, commercial interest rates go up. And as it goes down, commercial interest rates generally follow suit. Okay. So what the Fed just did the other day, which I thought was pretty interesting, and I heard about this on the Trepwire podcast.
I was about to say, Lonnie Hendry would know all about this.
Yeah, Lonnie could really explain all this to us really well. Maybe we'll have to get him on to fix whatever this episode messes up. But
yeah, we'll do that live in January.
Yes. What they did was they said, we're going to stop issuing so many long-term
bonds,
treasuries, the 10 years, the 30 years, and we're going to focus more on short-term. And that made the yield for the 10-year drop because all of a sudden they're limiting the supply of these, which increases demand.
Mm-hmm.
And when demand goes up for 10-year treasuries, the yield actually goes down, which causes interest rates to go down. So we saw last week commercial interest rates actually went down.
Hey. Still don't like the Fed though.
But
whose side should I be on there?
I'm just telling you what happened.
Yeah, okay.
But like if I go to a bank and I want to do a commercial deal and they're going to quote me a commercial loan, what the Fed does with the monetary policy and setting short-term interest rates, that plays a role. Inflation plays a role. What I look like plays a role.
Like how you're dressed?
Yeah, totally. It might. But I mean, what I look like financially on paper. So if they look at me and they think he's got a lot of strength, and if this deal goes bad, he'll still be able to pay it off.
Yeah.
I might get more favorable terms than somebody who's they deem higher risk.
Sure.
Financially. Okay.
Right.
So all that plays a role.
Yeah.
You know, on the residential side of things, like they're running your credit score.
Yeah. When we were looking into getting a mortgage, you know, my credit score is, not great. Not great.
Yeah. And so ours is pretty good.
Right.
And if all things being equal, if that score is different, I might get a lower interest rate than you from a lender just because of that one data point is different. So that it's more than just what the Fed's doing. But that's a very, very high level elementary explanation of
those are my favorite.
Kind of how the interest rates work.
I like
But
those.
here's how it's playing out. And here's kind of why I wanted to talk about it.
The interest rates are going down right just in time for...
No. Last week it went down that much.
Just a little bit, yeah. But not... Okay.
Like I'm nowhere close to suggesting that's a trend that's going to continue. Could have just been that happened that week. I haven't looked to see what it's happened this week.
Yeah, sure.
So
sure.
You'll see as the interest rates are going up, there's more at play than just what the Fed decides to do. So you might see it going up like this. And so 1 week versus the next, you might see a little,
gotcha.
Little downturn.
Yeah.
But when they lessen the supply of the 10-year Treasury by announcing, hey, we're going to issue less of the 10 years and the 30 years, and we're going to do more of that really short-term stuff, that drove up demand by limiting the supply, which made the yield go down.
Right.
According to Trepwire. That's why you saw last week commercial interest rates go down a little bit.
Right.
Yep. So if that continues to happen, I'm thrilled about that.
Yeah, okay? Perfect timing.
Because in our brokerage business, because money is so much more expensive to borrow, the transactional velocity has slowed down. Or in simpler language, less deals are happening.
Right.
And by some accounts, like some of these big national commercial real estate brokerages, they're down like 40, 50, 60% on deal volume.
Mm-hmm.
Now, at the same time, rising interest rates and inflation generally drive up, which is a term you've heard of before. So why don't you remind me?
Shit.
This is the one you're like, the next time you ask me, I'm going to get it right.
Yep.
Because conceptually, you get cap rates, but
yes. Okay.
Remind me what it is.
Well, I could, in simple terms, or here's this. When a cap rate goes up, the value goes down.
Correct.
Okay. Too long of a gap between last time we talked about it. The cap rate is basically the relation of the
somebody turned off, flipped the off switch. It was like,
I was just learning to love.
All right, look, you nailed the headline. Okay.
Right.
So as cap rates go up, values go down. And the inverse is true. As cap rates go down, values go up.
Yes.
Right. The reason that's true is the net operating income divided by the cap rate, which is a percentage,
is the value.
Mm-hmm. Like that's the equation.
Right.
Or if you know the value and the cap rate, you multiply the value by the cap rate and you can figure out what the net operating income is.
Mm-hmm.
Or if you know the NOI and you know the value, you can figure out what the cap rate is. So it's one of those equations like way back in 6th grade or 7th grade or whenever you actually took algebra.
Yeah.
If you have 3 variables and you know 2 of them, you can figure out what the third one is.
Yeah.
Okay. So cap rate, if interest rates go up, inflation's going up, a lot of times cap rates will follow and go up as well.
Okay.
Now, I don't remember why I asked you about cap rates in the first place.
Well,
what were we talking about right before that?
Right before that, we're talking about
And there he goes again.
What were we talking about? Anyway, cop rate. Oh, yeah. So the interest rates have gone down a little bit. The supply and demand of the 10-year yield bonds are down, right? So...
Oh, but how this plays out on the commercial real estate side is as interest rates are going up, as they have, it's slowed transactional velocity, right? So not as many deals are happening. But it also drives cap rates up, which decreases value. So we've had a market over the last year, 18 months, where deal flow is slowing significantly all across the United States. Now, you said it earlier, commercial real estate is hyper local. It's very local. So you may still be in a market where there's a tremendous amount of demand and job growth, and it's still driving deal flow. But deal flow is slowing overall by a lot. By some accounts, more than half of what last year was. And values are going down at the same time. So that exacerbates the problem of deal flow, because many sellers, in fact, almost all sellers, overvalue their property.
Yeah.
And this is true. Have you heard this? I think this is called prospect theory, I think. If I get this wrong, you can just correct me in the comments or whatever. But this economist, Nobel Prize winner, I think, named Daniel Kahneman, I believe was his name, came up with this idea, tested it, improved this, and I think it's called prospect theory. And it says this: if I own something, I will value it higher than what I would pay for it if I didn't own it. And so he did a number of tests with a coffee mug, okay? And he told these students or whatever, like, you own the coffee mug, how much would you sell it for? And the average was like $5 or whatever. And the other group of students, how much would you pay for the coffee cup? And it was like $2 and some odd cents. And it just started to show the gap between if you own it, you value it more. Or in other words, you're more likely to grasp harder not to lose something than you would be to pay to gain it in the first place.
Yeah.
I believe that's called prospect theory.
Okay.
So here's what we've got. We've got a whole bunch of owners of commercial real estate who remember just a few months ago in 2021 when their property was worth this. And now, because of forces they can't control, federal policy, macroeconomic forces, their property has now come down to here, and they don't like this number. And so they're still up here wanting this much money, and they missed their shot. They missed their window.
Yeah.
Much like the Buffalo Bills have missed their window to win a Super Bowl. Okay?
Yeah.
Right? So they have missed their window. So that dynamic's in play. All right? So there's this gap between what people are willing to pay and what people are willing to sell for, which also slows down transactional velocity, right? And buyers, now it's more expensive to borrow the money. So all these forces in play that have to do with interest rates. Not only that, but if you did a deal in the last 5 years, you're about to have to refinance.
Oh, right.
Because of how we describe these commercial loans. They're amortized over a certain amount of years, but almost all of them have shorter terms that require a balloon payment, and 5 seems to be the most normal one. And so if you back up 4 years from now, well, the market was pretty good.
Yeah.
You know, COVID had just hit, but the federal government flooded the market with PPP money and all this free money they flooded in.
Yeah.
And so all of a sudden, you had all these businesses getting these big PPP checks, and they didn't need them.
Yeah.
Matter of fact, because people were stuck at home, they started renovating and doing all this stuff. So demand for all these, especially these blue-collar jobs, exploded. And so as their business is exploding, Uncle Sam gives them a big, fat check at the same time.
Right. Thanks, Donald Trump.
So a lot of these guys went and started doing deals or might have invested in deals. And so we saw in commercial real estate, we had some of our best years in COVID. There's a lot of demand. Industrial exploded, residential, multifamily exploded, retail as long as you weren't a mall or a super regional mall, actually did really well.
Miracle Grow.
After the first, I don't know.
That exploded.
Miracle Grow?
Yeah, the stuff that you buy to fertilize your plants. Just fun fact, Miracle Grow went through the roof.
So a lot more people bought Miracle Grow?
Yeah, because they were at home. They're like,
well,
I can do my garden now.
I thought this was some joke I missed.
Well, no, it was very random.
Okay.
And I just remember that fact of like, you're looking and you're like, Amazon goes through the roof, all these, Zoom. And it's like, oh, I wish I would have seen it. And then you look and it's like, Miracle Grow is right there with them. And you're like, what?
Yeah, because people were gardening because they were stuck at home.
That's right, yeah.
Yeah, so...
I had to derail there.
Well, thank you.
Yeah.
I think I actually remember where I was when you threw Miracle Grow at me.
Mm-hmm. So
all these deals start getting done, development deals, and these people are getting, a lot of these are interest-only loans while you develop a project at low rates because rates were super low. It's almost that the interest rates are almost so low that people were referring to borrowing money as free money.
Yeah.
Like it almost cost nothing.
Wow.
They do their project, and then once it's stabilized, they put permanent long-term debt on it. Well, a lot of that's happening right now. Except they didn't expect 7.25%, 7.5%. They might have underwritten the deal at like, maybe I'll have to pay 4% by then.
Right.
And so now their cost of the debt could be double what they anticipated, and at the same time, the value of their project just took a big hit.
Yeah.
Because cap rates have gone up.
Mm-hmm.
So not only is the expense of the debt so much higher, but your lender might come to you and say, look, we're not comfortable at 70% loan to value now. We need to be at 60% loan to value. So we're only going to lend you 60% of what the property's worth.
Mm-hmm.
And, oh, by the way, the property's worth a whole lot less now than what we anticipated. So for these people to keep the deal, they now have to put money in to secure. So the costs have gone up. The lenders will lend less percentage on a value that's much less. And so now we have this new term, cash in refi. Used to be a cash out refi.
Mm-hmm.
Buy a house, 5 years later, my house is worth a lot more. I can refinance, pull some of that equity out, and go do something stupid like buy a boat or something
That is stupid.
Yep.
Yep.
Or do whatever you want with that money, I guess. But those are cash out refis. And a lot of people on the residential side will go buy a house, renovate it, rent it, refinance, pull all their money out of it, and then go do the next deal. And they'll just sort of daisy chain that thing, which works until it doesn't, like now. And now all of a sudden they go to do the refi and their house isn't worth what it is and interest rates are higher and all that stuff. And then if they have to start refinancing some of those loans on the daisy chain that they've done in the past, the whole thing breaks down. And this is why people go bankrupt in commercial real estate, because they undervalue the risk associated with the debt.
Yeah.
And you can't predict the future. And so
on
the commercial side, you've got these folks, and they did these big, big deals, estimating big, big values. Now the values aren't there, and the loan to values have shrunk. And now for them to keep the deal, they have to come to like some of these $100 million deals. They might have to bring 10, 20 million to give to the bank just so that they can get their permanent financing in the first place.
Oh my goodness.
So now, another scenario that's happening is, well, those are kind of like your development deals, or you buy a rundown apartment complex and you put, stabilizing type financing. So it's interest only, and you renovate, raise the tenant profile, raise the rents, and then you put permanent financing. So that would kind of be in the scenario we just laid out. But you also have people who just bought properties with 5-year terms, institutions, these bigger type investments that are using CMBS financing and that kind of thing. And their terms up. So they didn't have interest only on the deal, but they just, normal, bought a cash flowing property. And now 5 years later, the term is up and they have to refinance, and their cost to borrow has doubled or,
Yeah.
or worse. And same deal. Values have come down quite a bit, and lenders aren't willing to lend as high on the loan to values, and they might have to put money in or sell at a lower rate, take a big haircut on the value, or just give the keys back to the bank.
Right.
I'm out. You can have it now. And so because of these, banks don't like that.
Yeah.
So based on all that, some of us are anticipating that there might be somewhat of a bloodbath coming in the next 1 to 2 years, as all these deals need to be refinanced, either can't be refinanced. And so there are going to be some properties where banks will end up owning.
Right.
There will be some of these loans that'll be extended, like we talked about before. And if any of these owners can figure out a way to ride the wave, like make it through the storm, they're going to end up being okay, I think.
Yeah.
These changes in interest rates, and the reason why they're reported on so much is because they have very, very real effects with what's going on in the market.
It seems like since, I guess, last December or January when we started doing this and started talking about this, and Casey Conway and Lonnie and all, like everything that's been happening while I've been learning about commercial real estate, it just seems like interest rates have been at the top of the list of talking points.
Yeah, for sure.
Yeah. Man, and I had no clue what they were. Thanks.
And last week, you know what the Fed did?
What?
They didn't raise rates.
They didn't.
They left them where they were.
Well, that's nice.
There were many of the smart people at the beginning of the year who predicted we'd start to see rate decreases by the end of 2023 or maybe at the beginning of 2024. Now, the smart people seem to think it's going to be 2025.
Wow.
And so you're hearing things like survive till 25. And
oh, yeah. Yeah.
But it'll be interesting to see when the interest rate actually peaks and starts to come back down.
Yeah.
And maybe we're at that point, but there's no way to tell at this point.
Yeah, you don't know. But you're about to do a deal, right? You're about to do a deal, and you're going in 50-50 because where the interest rates are at, right? 50% borrow from the bank, 50% raise the money, and then what you are going to want to try to do is to get the shortest term possible, right? Wouldn't you want to get so you can refinance at a better interest rate?
No, what I'm going to try to do and what we've done is I need to make sure that if the interest rate is the same, like I need this deal to work with the interest rate we have going into the deal.
Yeah.
If I have to at some point refinance to a lower interest rate to make the deal look good, I shouldn't do the deal.
Yeah.
So the way I've tried to insulate ourselves from the risk of interest rate is to just borrow 50% as opposed to traditionally we might have borrowed more.
Yeah. Okay.
And a lot of people, I got a buddy who'll borrow every cent he can. As you get positive leverage, you get a better return the more you borrow, as long as the interest rate generally is lower than the cap rate. If that's true, you get positive leverage.
Right.
On paper, it just looks a lot better. And so if banks will lend 80% of the value, 80% loan to value, he'll take 80% and he'll do it over and over and over again.
Yeah.
And if he has to refinance in the next year, he's going to be in big trouble.
Yeah, big trouble. Right. You also got a friend in Alabama that's prospecting banks. Is that right? So that's a good move too. Have you thought about doing that? Or is that even...
Yeah. Yes and no. I have thought about it a little bit. We did this in 2008 when the great financial crisis, Great Recession, whatever you want to call it. When all that went down, I was with a company called SVN, and we put together a group that was going to be the distressed assets group, or I forget what we were going to call it, or what it was going to be called. And it was set up to serve the banks and all the real estate that they were going to get back.
Yeah.
And it didn't happen. The banks extended all these loans. because they didn't want the property back. The bloodbath did not materialize. I think there will be more of that this time around.
Yeah.
But if I look, we're in a small market, and if I look at our stable of clients that we work with, like I can't identify one that I think is going to be in trouble. And so I do kind of track on the larger deals, like the CMBS finance type deals. You can go look and see, are there properties that are about to be refinanced? And in our area of the country, like Western Kentucky, there's very, very little of that.
Yeah.
So I wonder a little bit if you're going to have all that bank real estate owned, the REO stuff.
Yeah.
But yeah, in different parts of the market, it may make a whole lot more sense.
Yeah.
Than what it might here. But
yeah, sure.
We've got a lot of owner user property, and generally the property that's owned by the business that occupies it, like if their business is good, they're going to be fine.
Yeah.
And so you'll see less of that distress than you'll see on high leveraged investment deals, where that note's coming due, and they're either going to have to bring a lot of money that they don't want to and do a cash in refi, or they're going to be forced to sell, or they're going to hand the keys back. We don't have a lot of that type of real estate in our market.
Yeah, sure. Yeah.
But for the other ones, yeah, man, I'd be making those banks my friends, serving their socks off, developing those relationships, because I think there will be opportunities there.
Yeah.
We might see a little bit of that here, but it'll be a lot more insulated.
Yeah.
Just because we don't have as much investment real estate here.
Right. That's right. Yeah.
Yeah.
Yeah. Cool. Is that it?
I think so. You want a quiz?
Yeah.
All right, pop quiz.
Yes, I do.
So loud.
Sorry. Too loud. Too loud. That's a birdie now. Oh, yowd.
Oh, she says yowd?
Yowd. Oh, yowd. Yeah.
Okay. So, question number 1.
Yes.
What is LTV? I don't think I said it that way, but you can probably figure it out. What's LTV?
LTV.
And why does it matter?
LTV.
Loan to...
Oh, yes. Loan to value.
Yes.
Yes. Loan to value. And why does loan to value matter?
Because how's it playing out right now? What is it first? And then how's it playing out?
Loan to value is how much what percentage you're able to borrow
versus the
amount, the value of the
property.
The property.
Yep, that's exactly right. So if it's $1 million property and 70% loan to value, the bank would lend up to
70%
or $700,000.
Yeah.
And if you want to buy that property, you got to figure out how to come up with the $300,000. That's your down payment, or
Gotcha. That clarified it.
Yep.
Yeah,
Loan
that
to
made
value.
sense. So, yeah.
Now, how is that playing out right now?
The loan to value is pretty low. So the percentage is. Did you tell me a percent of the LTV?
I mean, I threw out some percentages, but it would be bank specific. But to your point, banks have reduced the LTVs pretty much across the board.
So you can't borrow as much.
Yeah. Now, if you have to refinance and you're coming out of a 70% LTV, going into a 60% LTV, and your values have come down at the same time,
no good.
What do you have to do?
You have to either sell or cash in.
Cash in. You got to bring
cash in.
In
refi.
order to refinance, you have to give money to the bank.
Yeah, that's right.
Which is backwards
cash
of what normally happens.
That's right. Was that question number 2, or was that still question 1?
Well, it was a compound question. We want to do.
No, that's
okay.
Fine. Yeah.
So it's a question. So you understand the concept. That's good. Okay. What is a 10-year treasury?
Yield? 10-year.
I mean, what is it?
10-year. So it's a bond that you can buy that the government is selling, I guess.
Yeah.
So you're buying that, and essentially the government gives you interest payments, and with the 10-year means that it at 10 years you get your money back.
Yeah.
Yeah.
So it's a bond instrument that the government uses to
Borrow money, yeah.
from its own people
Right.
or other foreign governments or whoever buys the bonds.
Yeah.
And they make interest payments to the bondholder until the bond matures, and then they give back that initial amount.
Matures.
Yep.
That's the word I was looking
Matures.
for. Matures. I was about to say it masticizes, but that's not even a word, I don't think.
If it is, it doesn't sound pleasant.
No, it doesn't. Does it? Masticizes?
Yeah, let's just keep moving.
Okay.
All right, question 3. What is the formula for cap rates? How do you figure out what a cap rate is?
Yeah, it's your NOI divided by the value.
Yes.
Hey!
Yes!
Yeah, baby!
It only took 9 months.
Yeah, I know.
That's
Man.
exactly right. So the cap rate is the net operating income divided by the value of the property.
Yes.
That's great. And so follow on question 4.
Sure.
If interest rates are going up, what normally happens to cap rates? This is not an always, this is not written in stone, but normally if interest rates go up, what happens to cap rates?
Cap rates typically go up as well.
And
The value goes down.
that is correct, and the value goes down.
Yeah.
Yep, that's absolutely correct. Nice.
Sign me up.
I'm so proud.
Oh, man.
Okay, and question number 5. You ready for this?
Yeah, I am.
Who is the Marine Corps' mama?
The Navy.
The Navy, that's right.
I'm
They're
sorry.
just
Wait.
so motherly.
The Navy.
We don't want to offend these guys. They'll send their SEALs after us, and those are bad, man.
Oh, yeah, the Navy SEALs. Well, we're not talking about the Navy SEALs. You know, that's a different breed.
Well, it's a different breed, but it's
Still the Navy?
still the Navy.
Well, so are the Marines. The Marines are technically
A
part of the Navy.
department of the Navy. And at this point, I'm required to say we're the men's department. So you've never heard that before?
No.
Okay, because that's like
That's the
you're
thing.
almost required to say it. Like I almost just.
Yeah.
But
That's funny. Yeah.
my time in the Marine Corps, like we always had a great respect for the SEALs, and we had a great respect for the Navy corpsmen, which are essentially the docs.
Yeah.
And we use, like the Marine Corps does not have their own doctors.
Right.
Like we use the Navy. So like the Navy corpsmen, especially the ones that are attached to like infantry units, they're the real deal as well.
Yeah.
Yeah, for sure.
Yeah.
But that's just all weird, funny,
Right.
inter-service rivalries and stuff.
I'll edit this in good taste.
All these people are,
A lot of respect.
professionals and should garner the respect of the nation for sure.
Yes. And they have mine.
But the Marines are the best.
Yeah, Marines are the best.
Yeah.
Of course, that's no disrespect to all the other ones, but if you're not a Marine, you go suck a big toe. I'll edit it in good taste.
Yes, please do.
Yeah. All right, cool. Great.
Good to go.
All right, interest rates. You interested in hitting that subscribe button?
Oh, yes.
Yes. Thanks for watching. Please consider subscribing to our YouTube channel. Sign up for our email newsletter in the comments. You can follow us on TikTok, Facebook, Instagram, all those. Twitter, follow Bo Barron CCIM. Leave a comment with any questions that you have. Please leave a review on whatever podcast platform that you're listening on. That helps us out a great deal in this world. And come back next week for another episode of Commercially Speaking.